At 34, Ryan thought he was doing what responsible people were supposed to do. He had a stable job, a 401k, a few index funds, and enough financial discipline to believe he was in the market. That phrase sounded reassuring. It made him feel like he was participating in the same machine that built wealth for everyone else. But one night, after reading that roughly 93% of stocks in America are owned by the top 10% of households, he had the kind of financial realization that changes how you see the entire system. He was in the market, but he was not in it the way he thought he was. That statistic sounds like a headline about inequality, and it is, but it is also something much more practical. It explains why the stock market can feel strong while most people do not. It explains why markets can surge while millions of Americans still feel financially stuck. And it explains one of the most misunderstood truths in modern finance. The stock market is not the economy, and for most Americans, it is not even close. This is where people get psychologically misled. When the market goes up, headlines frame it like national progress. Confidence rises. Politicians celebrate. Financial media treat market gains like broad prosperity. But Ryan started noticing something strange. Every time the market rallied, his life barely changed. Groceries were still expensive. Housing was still expensive. Insurance still went up. His 401k moved, sure, but his day-to-day financial reality did not suddenly feel easier. That's when the disconnect became obvious. The market can rise dramatically without meaningfully changing life for the average person because most of the gains go to people who already own most of the assets. That's not ideology, that's structure. And once you understand that structure, the market starts looking very different. Most people think being in the market means they benefit when stocks rise. Technically, yes. Practically, not equally. A person with $8,000 in index funds and a person with $8 million in equities are both invested, but they are not experiencing the same market. When stocks rise 10%, one person sees modest progress. The other sees life-changing capital growth. That's the real meaning behind the 93% statistic. The market does create wealth. It just creates most of it for the people who already own enough assets for market growth to matter at scale. If you've ever wondered why the market can feel strong while everyday life still feels expensive, this is where the answer starts. Make sure you like, subscribe, and join Andrew Finance because in the next part, we're breaking down what this ownership gap actually means, why most people misunderstand how wealth is built in the market, and what the average investor gets wrong about what invested really means.
What Ryan realized next was even more important. The problem was not that average people were locked out of the market. The problem was that most people misunderstand how market wealth is actually built. They think participation is the same as exposure, and exposure is the same as scale. It is not. That is the misunderstanding sitting underneath almost every conversation about investing in America. Yes, millions of people own stocks through retirement accounts, brokerage apps, index funds, pensions. That part is true, but ownership is not evenly distributed, and neither is the outcome. That is what the 93% figure really exposes. Most people are technically in the market. Very few people are positioned for the market to materially change their life. That is the difference. Ryan had spent years doing what most financially responsible Americans are told to do: contribute regularly, buy broad index funds, stay patient, think long-term. And none of that was wrong, but what he had never fully understood was this: the stock market does not become transformative because you participate. It becomes transformative when the scale of your ownership becomes large enough for market growth to move your life. That is the real dividing line. For most households, market participation is helpful. For wealthy households, market ownership is accelerative. Those are two very different experiences. This is why stock market gains often widen financial inequality, even while helping everyone who participates. The wealthy do not just earn more from the market because they are smarter. They earn more because they own more capital, more shares, more business exposure, more assets positioned to compound. And once you understand that, the market starts looking less like a democratic wealth machine and more like what it really is, a multiplier. It does not create equal outcomes, it amplifies existing capital. That is the part most people miss. The market is not unfair because average people cannot invest. It is unequal because compounding behaves very differently at different scales. A 9% annual return on $10,000 is progress. A 9% annual return on $10 million is power. Same market, same percentage, completely different life outcome. That is what people mean when they say the market rewards ownership, not just access, ownership at scale. And psychologically, this is where average investors get confused. They assume the market is broken because it does not feel transformative fast enough. But the market was never designed to make small ownership feel dramatic quickly. It rewards time, scale, and consistency in that order. That does not mean average investors should stop investing. It means they need to understand what investing is actually doing. For most people, the market is not an escape hatch, it's a long-term ownership tool. And the faster you understand that, the better your expectations become.
What this means for the average investor is simple, but uncomfortable. The stock market is not a shortcut. It is not a rescue plan, and it is not designed to make small amounts of capital feel dramatic quickly. That is the first mindset shift most people need. Ryan stopped looking at the market like a place that was supposed to change his life fast. He started looking at it for what it actually was, a long-term ownership system that rewards patience, scale, and consistency more than urgency. That changed everything, because once you stop expecting the market to feel exciting, you start using it correctly. The average investor gets into trouble when they expect stock market returns to solve a structural income problem, fix lifestyle inflation, or create wealth without meaningful ownership. That is where frustration starts. The market is powerful, but only when used for what it actually does best. It compounds capital over time. That is it. And that is enough if you understand the game you are playing. Ryan realized the goal was never to beat the market. The goal was to increase how much of it he owned over time. That is the real strategy most people miss. The wealthy do not win because they predict better. They win because they own more for longer. That is the real lesson inside the 93% statistic. If ownership is what the market rewards most, then the average investor's job is not to chase excitement, it is to steadily increase ownership. More consistent contributions, more years invested, less panic, less interruption, less emotional decision-making. That is how ordinary investors make the market work in their favor, not by behaving like traders, by behaving like owners. And this is where most people finally understand the real truth about the market. It is not a machine that makes everyone rich equally. It is a machine that rewards whoever can stay invested, keep accumulating, and let compounding do its job long enough to matter. That may sound less exciting than what social media sells, but it is much closer to reality. The market does build wealth. It just does it slower, quieter, and more unevenly than most people expect. And once you understand that, the frustration starts fading, because the goal stops being fast transformation and starts becoming steady ownership. That is the real path available to most people. Not instant wealth, gradual leverage. Not financial fantasy, financial scale, built slowly enough to become real.
If this video opened your eyes, make sure you subscribe, because what you learn today can save your future tomorrow.